Okay, we'll go ahead and call our meeting to order. The first order of business is to consider the minutes of our March 16 meeting.
I'll move to approve as submitted.
Second.
All those in favor?
Aye.
Any opposed? Okay, our next order of business is to consider some amendments to the plan document. These are mainly administrative changes. We have the Secure Act of 2019, which requires plan documents to be amended by the end of the year to reflect the increased required minimum distribution age. And then we're also required to update the language about the actuarial tables to reference the specific regulations as listed in the plan amendment. Are there any questions about that language? Okay, we also are looking to update our membership, or our pension committee membership and requirements. Right now we require 8 members, 3 of which must be participants of the plan. One of those participants cannot be an officer or department head and only serves 1 year. We would like to reduce that committee size from 8 to 7 members and have all members serve 3-year terms, and then allow for participant and non-participant employees to serve on the committee. So this would also eliminate the exception that disqualifies managers and officers of the city from serving on the committee. Are there any questions about these changes? We do have one member, Mr. Usselton, who has asked to be removed from the committee, so rather than replacing him, if we go down to 7, we would just be status quo. So.
Need a motion to approve?
Yes, sir.
So made.
Second.
All those in favor?
Aye.
Any opposed? Okay. Our next item is to consider the engagement letter from USI for actuarial services for the plan. Are there any questions about the services proposed? I think this is just the same standard services they've provided. Yes, sir. Okay, is there a motion to approve?
I'll move.
Second.
Okay, all those in favor?
Aye.
Any opposed? Okay. All right, now we have Natalka here. Thank you, Natalka, for joining us. She's going to review the second quarter 22 and June 22 plan performance, flash reports, asset allocation, and rebalancing recommendations. Thank you again for coming.
Oh, thank you, Erin. It's always good to be here in person rather than just a voice on the other end of the line. And I have my associate, one of our consultants, Michael Hislop. And actually, I might let Michael start with what was the next point on the agenda, which is the market review.
Okay.
It just may help put the perspective of plan performance when we discuss it in better perspective to know what's going on in the economy and market. So, Michael, if you take a few minutes to walk us through that, that would be great.
Gladly. Thank you, Natalka. Yeah, so a little bit on the economic backdrop, and then I'll get into kind of the performance of the major asset classes over the second quarter. So inflation was 9.1% at the headline. Gasoline far outstripped other components of the CPI index, rising roughly 60%. Core inflation, ex-food and energy, rose 5.9%, which was a moderation versus last quarter's year-over-year print of 6.5%. In monetary policy, at the June meeting, members of the FOMC decided to raise their target for the federal funds rate to a range of 1.5% to 1.75%. The committee also reaffirmed their plans to continue reducing the holdings of Treasury and agency securities on the Federal Reserve balance sheet. In fiscal policy, the Congressional Budget Office projected that the federal budget deficit will shrink to $1 trillion in 2022 versus $2.8 trillion in 2021, and that the annual shortfall would average $1.6 trillion over the next 10 years. Outlays are expected to average a quarter of GDP over the period, and the federal debt is projected to shrink to 96% of GDP next year and to rise thereafter.
I think, Michael, just to interrupt you briefly, I don't think that anybody thought that in this environment that we would be seeing a shrinking in the federal, in the deficit.
Right.
but that's sort of the, the end of the COVID fiscal stimulus, all the checks going out and such. It's still going to be a difficult 10-year period going forward, but that was one of the things that sort of surprised me when we saw that number.
Yeah, just two final points on economics. We have in growth, the Bureau of Economic Analysis released their third and final estimate of first quarter real GDP on June 29th, a decrease of 1.6%. The Atlanta Fed's GDP Now model forecasts that the GDP growth for the second quarter will be a negative 1.5%. If we do hit 2 consecutive quarters of negative GDP, we will be in a technical recession. But just to kind of accompany that would be employment stats. The unemployment rate remained at 3.6% for the duration of the second quarter, each monthly print, in line with its pre-pandemic level of 3.5%. That was back in February 2020. So we finally made it down roughly to the pre-pandemic employment situation. Non-farm payrolls rose by 1.1 million over the quarter, up by 21.5 million since the onset of the pandemic, down just less than 0.5% from pre-pandemic levels. And if you would mind switching to page 4, you can see the graph that I have up on display here. I can go over kind of general asset classes here. So starting with fixed income,
So this would be, if you wanted to follow along, under the executive summary tab of your second quarter report, and as Michael said, page 4, because it might be difficult to see the screens.
Yeah. So starting with the bond market, the fixed income market. Losses in all sectors of the global fixed income market accelerated in the second quarter, as short and intermediate rates rose faster than those of the longer tenors to invert the yield curve as investors priced in a perceived likelihood of a recession. In U.S. bond markets, long-term spread products were punished most, as risk premia in below investment grade markets continued to expand. That's your high-yield bonds and your bank loans. The only positive performing sectors over the quarter were 3-month and under Treasury bills and overnight money. Foreign developed market yields rose sharply in the second quarter while credit spreads widened and the dollar strengthened to multi-decade highs against virtually all developed and emerging market currencies. Emerging market debt underperformed developed markets as investors began to speculate whether a, quote, wave of defaults would be coming to sovereigns across the emerging world. Treasury inflation-protected securities fell below nominal treasuries as the 10-year break-even rate fell from 2.8 to 2.3%. This marked a departure from a series of quarters where tips were outperforming. In the stock markets, in the U.S. stock markets posted double-digit negative performance across size and style ranges. Every major industry sector slipped, but low multiple defensive sectors, like consumer staples and utilities, protected to the downside, while both cyclical, which might be materials or industrials, and high multiple growth sectors, like consumer discretionary and technology, led the way down. Foreign developed market stocks, as measured by the EFA index, dropped 14.5%, outperforming large core U.S. stocks, which were down 16.7 on the Russell 1000 and 16.1% on the S&P 500. Emerging markets equities were down 11.5%, holding up better than U.S. and foreign developed markets, but remain among the weakest performers over a trailing 12-month period, down over 25%.
Okay, Michael, before you continue, so if you turn to page 5, there's also some other interesting heat maps and graphs on there. But when it comes to international and emerging markets, I think another sort of surprise is that in this environment, with everything going on with a war in Europe and a global, sort of recession looming, that you wouldn't think that developed and emerging market equities would be outperforming the U.S. Mm-hmm. And that is the case, at least amongst the indices. One of the reasons for that in the emerging markets indices is because Russia was dropped from the index in March with no survivor bias. So they're just sort of able to recalculate the index results and not have, they just sort of drop Russia and drop those positions. Active emerging market equity managers that held Russia, or active developed market managers that invested in Russia, have to hold those positions at zero and can't trade them until sanctions are lifted and markets reopen for Russian securities. So this year we're going to see quite a disconnect between active emerging market equity managers and the index because of the treatment of Russia and how it was able to be removed from the index as if it was never there. And this happens all the time, like in the bond markets, when, like in the aggregate bond index, if a bond drops below investment grade, it's just removed from the index like it was never there. And the index is recalculated, whereas an active bond manager has to keep it. It's now a junk bond, which is not necessarily a bad thing, but that the whole survivor bias issue when calculating index returns is certainly exacerbated when you have like a dramatic effect, like a country being removed from the index. So, but even within developed markets, which Russia was not in the EFA index, is outperforming the U.S. market in 2022. And again, it's just not something that you would anticipate, and particularly your developed international equity market manager, Dodge & Cox International Stock, we'll get into that a little bit more, has had a relatively, great year, both compared to an international index and a U.S. index. So it's, a lot of strange things have happened in the investment world this spring. And so just some of the relationships we're seeing are quite interesting. Michael, I'm sorry, I didn't mean to.
Excuse me, let me ask you a question, and I don't want to go too far down a rabbit hole, but if Russia just dries up, the debts are written off, what's the end? Has anybody really done any work on what the worldwide impact would be of their debt being written off, unable to pay, what the impact of that might be?
On the fixed income side, I think that it would have a bigger impact on the equity side in certain sectors like energy and such. On the debt side,
so the problem would be more isolated to the emerging markets. So Russian sovereigns, they pay out in two kinds of currencies generally. They've got ruble debt and then they have dollar debt. Something that's really common that you'll find in emerging market countries is that they'll issue their sovereign debt with dollar pay on their interest. But the owners of those sovereign debts are not typically other governments. They might be other fixed income funds. They might.
Well, and that's what I guess I'm saying. Yeah, I don't expect.
So yeah, even for like the Murfreesboro plan, for example, there's no global bond manager. The global bond manager was removed in 2020. Today, that fund and many others in its cohort might see an impact from something like this. Natalka and I, we work elsewhere with global bond funds. We have actually transferred a Russian sovereign bond from a fund that was closing into kind of just another account just to sit around. But the market value of that debt today is pennies on the dollar. If you had a $100 bond or a $100,000 bond paying US dollars from Russia, it would still be trading on 15 cents on the dollar or lower, with very little upside except for, the off chance that, things start to clear up.
I just was curious.
Yeah, I mean, Russian debt is not, it's not that large a portion of the global bond index, so I don't think it would have a significant impact.
Well, and I wasn't really necessarily talking about just debt. Equity would be a part of that. If I've got it in my portfolio and I've lost it, whatever. Okay.
Yep.
Okay, well, I guess kind of maybe one final comment is on page 5 on this graph of kind of global equity market returns. You know, part of the reason that EM stocks, you know, are performing better just over the last quarter really has more to do with kind of the performance leading up to it. The trailing year, it's among the worst performers, and then over the last 3 years, which, you know, in kind of from a market perspective, 3 years is still kind of on the shorter term of an equity market horizon. Emerging market stocks have been absolutely the worst place to invest. You haven't lost money, you haven't made money, you haven't beat inflation. It's been rather flat, zero handle on the annualized returns. So, you know, contrast that with kind of the carnage we're seeing here in the last quarter on the growth. On the upper left hand, where you see it's down, you know, mid cap and large cap growth are down 20+%. You know, you go out to the 3-year, you're still annualizing the best returns, particularly on that large cap growth. 12.6% is a rather optimistic type of annualized return in any kind of a financial risk asset. So I'll leave it there unless anybody has any specific questions on the market. I will turn it back to Natalka.
Yeah, no, just before we leave this page, you know, one of the things that I always look at when I look at this type of a heat map is just the disparity between growth and value across asset classes and also across capitalization ranges. So when you look at the 1-year return column and you see that large value is down 6.8%, and then you see small growth is down 33.4%. So, you know, that's, you know, about a 23% differential between those two asset classes. That's wide. That's historically wide. It doesn't usually get blown out that far. So, and, you know, and even just the difference between, you know, how within an asset class, large value for the trailing 1 year and small value. I mean, there's a 10% differential just because of the capitalization premium. So there are a lot of things that are getting, you know, we kept hearing last year that the market's overvalued. A lot of things, particularly in the growth camp, have been trimmed significantly. Values are certainly better. Even with this type of haircut and trimming that we've seen, there are, you know, historically, the growth stocks are still considered not cheap. They're better value than last year, but they're not historically cheap, which might mean we still have a little bit more downside to go, unfortunately. But, you know, in the short term, they're cheap. They could go lower. We'll have to see. And a lot of that will just depend on whether, you know, the Fed can organize some type of a soft landing or hard landing. You know, that's the other thing that, you know, the Fed was getting severely criticized for, you know, their policy error on inflation and thinking it was transitory longer than it was. And people were very critical of them not raising interest rates and beginning to taper the balance sheet. They're doing the interest rate hiking in earnest now. They are letting the balance sheet run off. They're not selling bonds off the balance sheet, but as they mature, they're not re-upping. And now they're getting severely criticized that they're raising rates too fast and they're going to drive us into a recession. I think they're damned if they do and they're damned if they don't.
Some things never change.
Yeah. So, but they do seem to be, you know, they do seem to have declared inflation and battling inflation public enemy number one. Mm-hmm. And I think they're willing to drive us into a recession. A lot of the people that we're talking to are sort of saying, it'll be a shallow recession, but they're willing to go to that extreme, and demand destruction, whether that's employment, getting housing prices down. I mean, that's what they're doing right now. And, you know, it'll be interesting to see after next week, you know, if next week's the last of the interest rate hikes for a while. Because people are already saying, well, by the first quarter of 2023, they're going to have to start cutting rates. So that's a long-winded way of saying we might be seeing, or we might have seen in the first 6 months of this year, most of the damage in the bond market. Because just as growth stocks have become better values, all of a sudden now bonds are actually yielding something. Real returns, you know, are improving. We still, you know, we have to get inflation down, but, you know, all of a sudden, you know, bonds, new money going into bonds today is, you know, in a better situation than it was, let's say, 3 months ago. So, but it will take a while for bond markets to recover. I mean, it's the worst start of the year in 40 years for bonds. And that's sort of across the board. There's really not been a lot of places to hide. Bank loans and high yield were holding up really pretty well until about mid-May, and they began to, you know, give way. So, so on that cheery note, we're going to go to how does all of this impact your portfolio from a performance standpoint. So if we go to page 6 in your reports, because again, even if you can see some of these graphs and tables, they're on the small side. Page 6 is really sort of, you know, a great summary of what's going on in your plan, both in dollar value terms and in performance. So at the top of the page, we see that in June 30th, the market value of the city's defined benefit plan assets was $154,839,724. During the second quarter, there were $491,748 of net outflows, your benefit payments, other plan expenses. And during the second quarter, there was $20.7 million of investment losses. And I will add the term unrealized losses, because they are unrealized. You know, at this point in time, you're not in a position where you have to sell or liquidate anything. So you've got dry powder to hang on, and hopefully we'll see some improvement in that in the next, you know, 6 to 12 months. From a performance standpoint, the total plan performance fell in line with the blended target index, minus 11.8% versus 11.5%. Year to date, you're 1% behind the blended target at minus 15.4 versus minus 14.3%. So if we take a look below, you have 4 investment teams that generate that total plan number. The global fixed income team was down in the first quarter minus 5.2% versus minus 4.6 for the blended target index. Year to date, down 9.8 versus 9%. Very ugly numbers. I don't think it helps to say your fixed income team was in the top quartile of broad fixed income managers, but that's just how ugly it was. There were 75% of the broad fixed income market that did worse than your team did. It's a very small consolation on a relative basis. Michael will dive into some of the detailed performance comments in a few minutes, and that you can find as I'm talking about the composites, if you wanted to look at the detailed performance, you could find that on page 17 through 19 of your performance reports. But you have a diversified fixed income team. Pinnacle manages a intermediate to short-term, primarily investment-grade credit strategy for you. They have done very well this year. Michael, if you can scroll down or shrink this down a little bit so I can just sort of see the performance of Pinnacle. I can actually, okay, there we go, thank you. So Pinnacle dropped less than their target index. They were down 1.9 versus 2.9, minus 2.9% in the second quarter, and they're 3% ahead of target year to date. So they're down only 4.6% versus 7.5%. And they're one of your largest fixed income managers, and they've been doing a great job. The weakness on your fixed income side came from TCW, which is a mortgage bond and securitized manager. And they're about 1 to 1.5% behind target. Michael will talk a little bit about that later. But that's where the weakness, if you will, in your portfolio on the fixed income side came from. If we look at your domestic equity team, you have 6 managers there representing different capitalization ranges from large, mid, to small, and you've got growth and value managers in each. No surprise, your value managers have done relatively well in this marketplace. Harbor mid-cap value and American Century small-cap value in particularly have done well. Janus Enterprise is your mid-cap growth manager. That's been one of the weakest performing sectors of the equity market, mid-cap growth and small-cap growth, and they have outperformed their target by like 10%. So they're still in negative territory, but within their space, they're doing a very good job. You want to go back? Yeah, sorry.
No, I didn't realize you were reading from here.
Yeah.
Sorry to talk.
And you have 4 global and international managers. One is pure international, that's Dodge & Cox International Stock. They have a core to value bias, and as I mentioned earlier, they're doing very well, both relative to their international index and also versus U.S. stocks. You've got 2 global equity managers, American Funds World Capital Growth and Income, and also Janus Research. Janus has more of a growth focus and also has no emerging markets exposure. And American Funds Capital Growth and Income is more value-oriented, so they're doing a little bit better than Janus this period. And you do have one emerging markets manager dedicated, Invesco, developing markets. And emerging markets, as Michael pointed out earlier, has been the weak place to be. They did have about 6% exposure to Russia, which has been marked to 0. They're also significant investors in China, which up until the second quarter of this year was also struggling. So they're having a tough year for you. And again, Michael can go into that a little bit, later. Your 4th team is your real assets team, and that has grown to be 4 managers. You have 1 natural resource manager, which has been on board for a number of years, the S&P North American Natural Resources Index Fund. Oil prices, as well as metal and mining, pulled back in the second quarter, so had a weak second quarter of performance, but they are your only positive performing manager year to date, up about 16%. You have a global REIT manager, real estate investment trust manager, Prudential. They had a weak quarter of performance. They are 65% invested in North America, but their European REIT holdings pulled them down in the second quarter. And then you have two domestic REIT managers, Cohen and Steers, which is navigating the environment quite well, and Principal US Realty, which is also doing okay, but not quite as well as Cohen and Steers. REITs were your best performing asset class last year. REITs are real estate equities, so they have fallen alongside equities in the first half of this year. But with REITs, their income stream is still very strong. I think that they are poised to stabilize and recover quite nicely. So we still think having real estate exposure is a positive for the plan. It is a good inflation hedge, and the income-producing properties make it a good or better surrogate for fixed income during a difficult period. As tough as the first 6 months has been for your REIT investments, we think that, we wouldn't reduce them at this point in time. So that is, overall performance. As I said, Michael will go into some of the funds, maybe the ones that have done particularly well or the ones that are on watch list status in a few minutes. I thought I would cover asset allocation unless somebody has any questions, on the broad performance of the management team. So if we go to page 7 of your reports, that's the asset allocation, the first of the asset allocation tables, and then there's more detail on page 9. But on page 7, on the bottom right, we see the target policy for the plan is to be 42% in broad equities, meaning domestic and international equities, 23% in real assets, so that's your real estate and your natural resources. You are investing in the equity portion of the real estate market as well as natural resources. So it is considered part of the equity universe. So in total, you have a 65% target to equities in your plan, but it's very diversified exposure, which we think is a positive in this kind of a market. Your target to fixed income is 34%, and then your liquidity, or what I call operational cash account, the target is 1%. If you look at the table above that target table, you'll see the current mix. So you are overweight equities, 46.3% versus the 42% target, despite the pullback that we've had. And I guess at the end of the second quarter, I can say, despite the correction that we had in the equity market, because we did see, unfortunately, a 20% drop in equity markets. But you were, overweight going into this year. Last year, we did a lot of trimming within equities, and very stubbornly, they kept growing back. And so the market is doing a little bit of trimming now for you, but still, you're still overweight in equities because fixed income has also been a negative environment. And you are also underweight in fixed income, 29.4% versus the 34% target. You were underweight going into this year because of the strong performance of equities last year, even though we tried to top off some fixed income last year. Right now, the underweight in fixed income is not really a problem. I think that right now it's better than being overweight in fixed income. So we're not overly concerned with that. You are on target with your real assets team at 22.2% versus a 23% target. As I said, we think that real estate has had a tough first 6 months, but we think it'll stabilize maybe more quickly than traditional equity markets. And we think that natural resources, despite the pullback that we saw in the second quarter and the drop in oil prices, I think that natural resources will still generate competitive performance. We still have to see what happens with gas and oil in the fall. It could be a very cold winter in Europe.
Yeah.
You know, and we're going to find out in the next 24 to 48 hours if Nord Stream 1 comes back online after the maintenance in Germany. So I think that there's still going to be a lot of volatility. You know, I would really like to see gas prices in the United States come down, both for car drivers and plane travelers and such. But at this point in time, I wouldn't reduce your natural resources exposure. I also don't know that I would add to it right now. We think that you have what you need in that regard. So we have kept you really for the past 18 to 24 months at double your weight in liquidity and operational cash. And even all of last year, some of the trimming that we did was to keep that double weight, because we just don't want to see you in a highly volatile market, whether you're going up or down, particularly when you're going down. You don't want to have to be turning to your fixed income or equity or real asset portfolio and raising money to make benefit payments. So we like to see you having 9 or so months, 9+ months in cash to cover your expenses, so that when we see a real downdraft in the market, and you sort of, the one thing you should keep in the back of your mind is you don't have to do anything for 9 months. And the plan, you can operate the plan as if nothing is going on. It gives you time to see if any trends are developing in the market or any direction is developing in the market, which might help you position the portfolio for coming out of this period. So we had no rebalancing recommendations for you for this month. Your operational cash was at 2.1%. I don't think you need to be raising much more than that. I don't think that right now is a good time to be repositioning, the portfolio. Before I let Michael talk about, I guess I'm going to let you, Michael, talk about some of the performance watch list and some of the outperformers and underperformers, and then I'll come back and finish with, things that we're looking at and working on as we look forward for your portfolio.
Yeah, absolutely. So I will jump to page 17, where I kind of tried to head earlier prematurely in our presentations. Page 17, I'll begin with fixed income managers. I'll zoom a bit here. Keep everything visible. Okay, so I'll start with a strong performer here. Pinnacle Fixed Income. It's a portfolio mainly of corporate bonds. Primarily corporate bonds, all investment grade, very strong performance. This is primarily, though, due to actually duration positioning. So the maturities of the bonds in the portfolio are shorter than that of the benchmark. They're less sensitive to fluctuations in interest rates. So, very kind of prescient move by the portfolio management there. To kind of move away from duration coming into the beginning of this year and the second quarter as interest rates really started to spike, following a heel turn from the Fed. One of the weakest performers, the weakest performer was Lord Abbett High Yield. So this fund invests pretty much exclusively in below investment grade bonds, ones that exhibit, a much higher level of coupon. They do tend to be shorter in tenor, But the issue with high-yield bonds this quarter was credit spreads, risk premia for below investment grade companies really expanded. It's become more expensive for kind of leveraged companies to finance. So high-yield bonds, they tend to be, hot in a good economy. They are not in a bad economy. So they underperformed, kind of narrowly, but as you can see, the benchmark itself did fall 10% over the quarter. Credit spreads on high yield came out to, that is the premium above a similar duration government security. The yield on the index now is 8%. This fund might be yielding, net of expenses and everything, somewhere in the 7% range. So, again, where previously a high-yield bond fund was, through last year, netting people an annual yield of 4 or 5%, it's roughly doubled. So it's backward-looking performance is looking bad, and I will mention, though, that it is not something, it's not as though defaults have been picking up to some kind of abnormal pace or anything like this. It's not as if there were bankruptcies in the portfolio. It's just that investors are afraid to go there, and with the lack of bid, market prices are coming down on below investment grade fixed income, whether it be bonds or loans. TCW total return was moved to watch list this quarter. Natalka and I actually met with them yesterday virtually. They're in Los Angeles, so we don't travel around that quickly. That fund underperformed its benchmark for both the quarter and the year to date. It's been 2 consecutive quarters of underperformance, and it's been significant enough, kind of in the longer term, to merit the decision to move them to watch list. The issue with this fund, the cause for the underperformance, actually has to do with their asset allocation versus the benchmark as well. Not a surprise, but what is the difference? The difference is that this Barclays mortgage-backed index is completely agency mortgages. It's Fannie Mae, Freddie Mac, and Ginnie Mae guaranteed mortgages. TCW seeks to add alpha, seeks excess return by investing in mortgage credit. That could be in the form of commercial mortgage-backed securities. That could also be in the form of non-agency residential mortgage-backed securities, those of which are kind of rarer, which is, kind of, is the draw for TCW, is that they have access and they have expertise in the areas of non-agency residential mortgage backs, and as well as kind of headliner type commercial mortgage backs, the single asset, single borrowers. Think, what kind of a mortgage would the Empire State Building have, that type of a loan. The issue there is these, both on the commercial and particularly on the non-agency residential side, they're not government guaranteed for the same reason that high-yield bonds underperformed investment grade is the reason that non-agency mortgage backs underperform agencies. So I won't kind of belabor that too much before I bore you all to tears. Moving on to page 18, let's talk a little bit about U.S. equity. So here, my presentation, forward a page. Let's bring up my watch list as well. So here, performance was also mixed. On an absolute basis, performance was very poor. Equities really sold off. To highlight an outperformer, I would point out Janus Enterprise. So Janus Enterprise is a mid-cap growth stock. Mid-cap growth has been a very difficult place to invest. Between mid-cap growth and small-cap growth, these are high multiple companies. They're small market caps. They're the most speculative position to capture more market share over time. But they just like high yield bonds, my example before, when the economy is great, small cap and mid cap growth tends to do quite well. When the economy is turning around, we're starting to get consecutive quarters of contraction in GDP. You're going to see these guys kind of lead the way down. So Harbor Midcap, why did they do so? Excuse me. Janus Enterprise, why did they do so well? It is their industry and security selection. They tend to focus more within the information technology, the more durable businesses. It may be a coincidence that the fund is called Janus Enterprise when they do invest kind of heavily in enterprise technology, your network equipment, your server, your enterprise technology is the type of securities they'll invest, instead of kind of these go growth type stocks, the ones that are suffering worst, your Netflixes and maybe your consumer discretionary companies, synthetic meats, for example. They did quite well in 2021. They're doing very poorly. Your kind of food tech and things of that nature. So yes, Janus Enterprise protected very well to the downside on an absolute basis. They kind of performed more in line with the general market. On the other side, well, your equity team in general was relatively strong. Your newest manager, American Century Small Cap Value, posted a strong quarter. These are low multiple, although they are small capitalization stocks. Again, I think when we were selecting this fund back in November, the actual sponsor of the portfolio, the management company, American Century, very well known, very kind of institutionally focused asset manager. They're invested in some of the things that are holding up, kind of best of all, your kind of non-bank financials, your industrial companies. These are, kind of, these are the types of stocks. They're boring. They're prosaic. Yeah, they're not going to, you're not going to see them in the headlines, but for good or bad reasons. In an economic downturn, though, they are kind of holding up quite well. It was Harbor Mid-Cap Value who has had some difficulty, but they were removed from watch list. Excuse me. Why I just jumped ahead, but Harbor Mid-Cap Value is removed from watch list status, after kind of very strong relative performance over the quarter, year to date, and trailing year. So our cause for concern is beginning to allay here. Moving forward to global stocks. So let's go straight to emerging markets. Invesco, developing markets, very heavy in Russia, so year-to-date performance has been very poor. As Natalka mentioned earlier, even funds, when calculating performance, they marked a lot of their Russia holdings down to 0 in the first quarter. That performance is reflected in the year-to-date, but following that, much of the damage that we're seeing elsewhere in the world had been done kind of ahead of time. Emerging markets led the way down from the beginning of the year. So, next to Dodge and Cox, ironically, they're among the best performers on your global equity team. Dodge & Cox International Stock, Natalka mentioned earlier, very strong relative performance, your best relative performer among the equity team. They're just a strong active manager. I mean,
And much like Michael was saying, they tend to invest in a little bit more of a boring fashion.
Right.
So, ironically, they tend to invest pretty heavily in European financials, which a number of those have actually held up okay this year. But they also invest a lot in healthcare. So Roche, GlaxoSmithKline, a lot of the international. They invest in industrial companies and energy companies. So that has really helped them both in absolute and relative terms this year. And they don't invest much in technology at all, so.
Yeah, Janus Global Research, now they kind of performed in line with their benchmark. I'll just kind of mention there's something interesting a bit about the fund is The fund is actually managed by multiple teams, each focusing on individual industry sleeves. So there's a technology team, a healthcare team, an energy team, et cetera, et cetera. They performed in line with their benchmark. Their allocations is actually quite close to benchmark in terms of sectors. Unfortunately, in periods when we're having really high market turmoil, kind of your individual stock picking, when there's big swings in the market, you know, a lot of babies get thrown out with the bathwater. If you have a fund that's really kind of industry sector allocated in line with the benchmark, you'll generally tend to see performance in line with the benchmark. So that covers global equity. Let's touch a little bit on real assets, although Natalka really did kind of cover the real estate. I'd like to go kind of straight to the natural resources. So, you know, natural resources, although, you know, again, an absolute performance for the quarter of negative 10% is by no means, you know, positive. Year to date, you'll see that they are still quite positive, though. One of the things with natural resources is looking at these numbers, to me, is like very foreign. I can remember just a year ago looking at the trailing performance of this fund and any, you know, kind of commodity producer-focused fund, and seeing very dismal performance numbers, either negative or very flat for a very long term. Well, that's all changed. Here on real assets, trailing 5 years, it's your best performing fund. Trailing 3 years, you're nearly annualizing 10%. You know, the gas prices, the oil, timber, the prices of everything is very high. There's a lot of commodity producers have a unique ability to pass on the cost of input to consumers, and they also can have a lot more room for profit margin. I think kind of going forward from here, though, as commodity prices may remain stabilizing, we may not see them kind of growing at the same rate as kind of policymakers around the world do everything they can to kind of keep prices down. So that may be challenging for margins of commodity-focused equities. That's not to say that they should do quite poorly. It's just that, you know, perhaps we shouldn't expect them to annualize 20% a year like they have for the last year or so, or even 10% a year like they have for the last 3. Yeah, again, on real estate, you know, kind of just looking broadly, the global REIT fund did underperform both the U.S.-focused REIT funds. I think a lot of that is also due to just King dollar. The U.S. dollar is stronger than it's been versus foreign currencies in a very long time. You know, the euro over the quarter, or in recent weeks, actually, reached parity with the U.S. dollar. You know, $1, 1 euro, kind of very a rare thing. I think, you know, a euro was 99 cents at one point and broke parity, which is, you know, kind of interesting. But that's not going to be very positive for any kind of a, for example, if you own properties where the tenants are paying rent in euros, for that exact example, or yen, or any other currency that isn't a dollar. Or the same thing too for if you're selling a property. You know, your bid for your dollar is not going to come out lower because the dollar is just quite strong. It's just it's a currency headwind. I think is probably the biggest factor between your U.S. and your global REITs. You know, both at the portfolio level and at the underlying, you know, individual REIT level. So I've gone on for quite a long time here now. Do we have any questions, or is there anything that kind of stuck out that needs clarification? If not, I'd be happy to just either open it up more broadly or move back to Natalka.
Well, I was, you know, if there are no questions, I was just going to say, so, you know, what are we looking at now insofar as your portfolio is concerned? So, you know, Michael reviewed sort of the watch list status. So you have 2 funds on watch list, the Invesco Developing Markets and TCW. And the rest of your managers, as you see from his presentation, are really performing, you know, very close and in line with benchmarks, and doing, you know, relatively well in this marketplace. I started off by saying, when we covered the asset allocation topics, that you are broadly 65% in equity as a target, 34% in bonds, and 1% in cash. So we're going to look at your actuarial valuation reports. We're going to look at whether we think that that's still a good long-term benchmark for you to achieve your actuarial interest rate assumptions. I think it's probably pretty close. You know, I probably wouldn't see going down much in equities below 60. I don't think at this point would raise it above 65. So we're going to just be looking at fine-tuning that. And then we're also going to be looking at the composition of the fixed income portfolio. Right now, you have a lot of short-term investment-grade credit bonds. You have exposure to high yield and securitized through Lord Abbett, as well as the Western Asset Income Fund, which is a very diversified securitized fund. And you have a lot of mortgage exposure through TCW Total Return. Basically, your duration, if you take all of those managers into consideration, is somewhere between intermediate and short. None of them are long-term, you know, bond managers. So we're going to be taking a look at sort of that mix of managers and seeing if, you know, opportunistically, if the bond market is presenting us with opportunities to switch into something that's a little bit better valued, higher yielding at this point in time. We might not be quite as afraid of duration as we've been the last 10 years. We've positioned the portfolio literally for the last 10 years on the intermediate to short side because we've been waiting for interest rates to go up. Kept saying, you know, interest rates have been low, they've been artificially low, they've been, you know, manufactured to be low because of fiscal policies and such, but they've finally started to go up a bit. I don't know that they're going to go up that much more from where we are now. And that's why I say I think a lot of the damage has been done in the bond market. But so we might take some opportunity to see if we can maybe lengthen out the duration of some of your portfolio to capture some higher yields and or change the composition a little bit. As I said, you have a lot of mortgage exposure in there. Mortgages have taken a beating, along with a lot of other fixed income segments in the first 6 months of the year. Again, a lot of the damage might be behind us, but we might want to trim some of that exposure on strength as we come out of this. So those are the kinds of things that we're looking at, and you know, we'll be doing that in conjunction with the actuarial interest rate assumption, and you know, just position, you know, trying to position you for coming out of this, and hopefully taking advantage of, you know, some of the opportunities that have been created by this correction that we've been through. So any questions or concerns about either the asset mix, the investment management team, you know?
Just a comment, I suspect that all of our managers are going to be looking at the same thing we are. Their short intermediates are rolling off and opportunities to go in to benefit their investors.
Yeah,
that is correct.
Yeah, particularly Pinnacle is kind of the most flexible in terms of, you know, which direction they can head in the maturities of their portfolio. Some of the other funds, though, kind of have a mandate that's more, stuck in a short term. High yield bonds, for example, because of their higher level of coupon, they're just by nature lower in duration. If you're collecting a higher interest rate, duration is the time it takes to get your money back. You give $100, the time you get to get $100 back is going to be a lot shorter if every year you're getting $7, $8, $9, rather than in the investment grade side where you're getting $2, $3, $4 a year. It's the same case with Western Asset Income. It's a similar case with TCW, total return. So it may be kind of worth entertaining, again, pending some discussions with the actuary to see kind of what the ratio of pension assets are to the present value of the liability to participants, or to retirees, I should say. It's sometimes it can be a little bit, scary to take a bet to go far out on a maturity curve in bonds, because those are the most sensitive to changes in interest rates. When we see something like this, though, the market is already kind of saying, just by virtue of, say, for example, the rate on the 30-year Treasury is lower than it is on the 20-year. The rate on the 10-year Treasury is much lower than it is on the 2-year. So the yield curve is inverted. What is that saying? Saying the bond market doesn't believe that rates are going to be staying high for long, that we are headed for a recession, and that the Fed's going to do what they always do when something breaks, is they're going to slam those rates right back home to zero. Those long-term bonds do quite well in situations like that, as you'd imagine. Rates come down. If you've got 30 years of compounding that you can get an advance on, it might be worth kind of considering. So we will speak with the actuary, right, to find out about that ratio of assets to liabilities, and if the plan is in a position where duration can be started to be added, we may return to you with a search, a manager search, or something. Or at the very least, a conversation with Pinnacle to see what they can do with this account.
Yeah, when we leave here today, we're going to be going over to Pinnacle and visiting with them in person for the first time since COVID started. We've been in touch with them by phone a lot, but also, Charlie, to your point, we talk with a lot of fixed income managers, both your fixed income managers as well as fixed income managers for other clients, and yes, they are looking at the market right now, and a lot of them are beginning to lengthen duration. They're not as afraid of duration anymore. They're getting paid for it, finally. They are not shying away from high yield or investment grade. They feel that corporate balance sheets are still in really good shape. They feel that the defaults in high yield are not going to increase dramatically in 2023. Last year, both in 2020 and 2021, a lot of high yield companies rolled and extended their holdings, their financing. Their financing.
Yeah,
thank
maturity
you.
wall is 6 to 7.
And so, for the next 3 to 5 years, their financing is arranged. They don't need to go into the market to redo. So people are thinking this is not going to be a dramatic high yield, crash, type of scenario. We'll see. So they're selectively increasing their high yield exposure, and they're doing it by they're being very sensitive to what industry sectors that they're emphasizing as well. And a lot of the mortgage players in our conversation with TCW, at the beginning of this year, they were 50% invested in agency mortgages. At the end of the second quarter, that was up to 63% of the portfolio, because they were buying into sort of the weakness that they saw, but they think that's also going to be the first part of the market. Those guaranteed agency mortgages are going to do better than treasuries. And, so they're positioning themselves for that. I mean, they even went so far as to say in their unconstrained bond fund strategies at TCW, where they can invest in anything, anywhere, what are they increasing in the unconstrained bond funds? Agency mortgages, because they just feel that the market dynamics have, turned in that favor. So a lot of this, I mean, a lot of fixed income managers talk their book. So TCW is a big mortgage manager. They're going to have opinions on the mortgage market. There are other managers like Pinnacle that are more corporate managers. And as Michael said, I think one of the really impressive things about Pinnacle's performance on a year-to-date basis is they're all investment grade. They're not high yield. So, I think security selection, shorter duration, has really kept them out of trouble this year. And we'll find out a little bit more in about an hour. So we're, and it's not to say that we're not looking at opportunities within your equity portfolio, in domestic equity, for instance, you're invested across all capitalization ranges. You've got a growth and value manager in each of those ranges. We've tended to keep them pretty equal. And the market, if the market has favored large growth, your large growth managers and your mid-growth and small growth were doing better than the value managers the last few years. They had a little bit more in assets. We might have trimmed some of that back, redistributed it. Now the value managers are doing a little bit better. So your domestic equity management team is sort of self-correcting, almost, if you will. You're already there. I don't know that I would change and sort of say, okay, well, now's the time I think you should really be getting out of large cap and really overemphasizing your small cap managers. I think that there are opportunities across the capitalization ranges coming at us. So those are the kinds of things that we're looking at. And, we have done a lot of looking at the past 6 months, the real asset space, so I sort of shared our opinions with you on that. That's, we're sort of looking towards positioning you for hopefully what's coming in the next 6 to 12 months.
What's your attitude about the talk of recession? Deep, shallow? Your all's attitude, not what you hear. Right now, I think that I'm in the shallow camp. I think Chartwell is in the shallow camp, but I think that Chartwell has also been in the camp of, we feel like certain segments and sectors of the market have been in a recession. We're in a recession. Okay.
The technical definition, maybe not. And then, it's also, we may see like a recession on Main Street and not so much Wall Street. So, and that's my comments about corporations are still, balance sheets are in good shape and such. So Wall Street and corporate America are still pretty strong, whereas I think the recessionary impacts are being much stronger felt on Main Street. So, but I think that it will be, right now, from what I'm seeing, from what we're hearing from people that we're talking to, probably a shallow recession. Michael, do you have anything to add in that?
Yeah. So I think personally, again, kind of independently of what I've heard or what I've been told, the way I look at it is So we got an advance on economic growth. We got a super advance on kind of industrial or business activity due to very artificially low interest rates, very easy monetary fiscal conditions. A lot of literally free money, check writing to businesses and consumers. Until inflation started to tick up. Now inflation is public enemy number one. We are kind of experiencing now for 2 quarters in a row, it's starting to look like 2 modest declines in the rate of GDP. So again, minus 1.6 final estimate in Q1. Current estimate for Q2 is negative 1.5. I think if we do get a technical, again, the Bureau of Economic Analysis defines a recession as 2 consecutive quarters of contraction in GDP. If we do see that combined with a moderation in inflation, which I think that there is a chance of seeing, given that inflation last year, this time, was starting to tick up into the 5% range. That gives a much higher denominator in the year over year. So that gives a better base effect for a lower inflation. We've already seen from first quarter to second quarter, core CPI, that's minus food and energy, that's the stickier part, that's the part that really we should be more concerned, and that's the more in line with PCE, the measure used by the Fed. I think that we may see inflation continue to moderate. We may see the financial conditions begin to ease again. We may see the monetary positions begin to ease again. And, that would give us a whopping down 3% or so on GDP for the recession. And the moment that cheap money comes back, the whole world is fiending for it, not just the businesses. Globally we are in a position where the earth doesn't spin without low rates. So we'll get back to it the moment the prices get under control. If they don't, I have no outlook,
Okay. Hold on.
Yeah.
Yeah, hold on.
That's a nice way of saying it. Yeah.
Thank you.
All right, thank you.
Okay, well, thank you, both of you, and Natalka and Michael, for all of your information here. Did y'all have any other questions for Chartwell? Okay. Our last item is just for your information. It's our annual compliance letter from the state, which is just noting that, once again, the plan is in compliance with state law with regards to our funding requirements. Did y'all have any questions about that?
That's good.
It's good.
All right.
Always good to be in compliance.
Yeah.
Absolutely. Is there any other business to come?
Yeah. I just wanted to give a brief update. Chris said that sometimes they want this. Just to let you know, the number of current retirees that we have right now are 361.
They're drawing benefits.
Correct. Okay. We have 20 employees that are utilizing benefit hours for retirement. This is of June 30th, 2022. We had 9 employees put in a request for retirement, which is right on target with July, and we have 281 deferred vested right now.
281.
Deferred vested, so that means they've left, okay, and they're in the drawer, and they'll be receiving benefits at some point. Our monthly pension that we do is $404,000.
And so I know we've looked at rate of retirements over time, and we're still on where we thought we would be as far as the number of people that are retiring at the times that we thought they would. Is that kind of rolling along like we predicted? Okay, good.
Because July is usually busy because of waiting on if they get a raise, and several people in getting numbers, but nothing that's big right now.
Okay, thanks.
And deferred vested, that's also current employees, right? That are just,
That's all former employees.
I'm a deferred vested, right? So, because I'm deferred in the pension plan, but I'm obviously not retired, so I'm still employed. I think.
Yeah, it's 2 separate things, and it's not on this, and I wrote myself a note to put it on here, a number of employees on the pension plan. The deferred vested have actually left employment with the city. So by the next time I'm going to add it on there, the number of employees that are actually in the pension plan that are current employees.
Okay. Okay. Is there anything else? Okay, well, I think we can adjourn then. Thank y'all.
Thank y'all.
Thank you, everyone.
Thank you.